So today I want to stick my head out a little bit and say that with this video, I will save some of you at least hundreds or even thousands of hours and maybe a lot of money as well. So with this video, I will attempt to explain why Fibonacci's work sometimes and sometimes they don't. And it will actually explain why using indicators, irrespectively of what the market is doing, is also futile, and why tuning your indicator to the market doesn't matter. So let me begin by showing you these three different Fibonacci tools that I've drawn out. So the first one, we have these lines represent the moves of the market. So with this first Fibonacci graph that I have, the market has moved up for some time and then moved down an equal amount. So we have a 100% retracement. This is the weakest the market can be without actually reversing completely and starting to go in the other direction. So we have a market that goes up and then goes down an equal amount. So if we take this and we just copy that, we have, what do we have? We have a trend. We have a trading range, right? So this is a trading range. So a trading range is actually a weak form of market. Can you trade a trading range? Of course you can. If you know that we are in a trading range, you can use the old method of buying low, selling high, shorting high and buying back low. And you can do this as long as the trading range continues. So once you suspect you're in a trading range, you can adapt your behavior to that trading range. If you measure this with the Fibonacci, you won't get anything. You will just get, it will just go right through all these levels, right? So that's pretty self-explanatory. So let's take a look at an uptrending market. So this market is going to the 618 level, and then it's doing it again. Let me copy this. So now we are trending up like this with higher highs and higher lows. So some people will say that they are looking for 618 retracement. That's their favorite retracement levels. And you even have some strategies that, for example, the ICT strategy where you have optimal trade entry, which is around these levels approximately, where you start to look for these, and you're actually in a trending market. So every time it goes to the 618, you buy, 618, you buy. And you scout around looking for markets like that. So this is obviously a stronger market than the ranging market. Still very self-explanatory. Let's now consider a market that only retraces to the 236 level. Let me copy that. And one more time. So this market is very strong. It is unable to go to the 618 level or any of the other levels below. It keeps just pulling back to the 236 levels. So this is a much stronger market. We could even say that we could call this a tight bull channel. And we could call this a broad bull channel. So which market would you rather be in? Would you be in this market or this market? Obviously, you want to be in the strongest market if you're trading trends, trying to catch a trend. And if you're trading any type of pullbacks, you're a trend trader. So when you're saying that your favorite Fibonacci level is the 618 level, you're actually choosing not to participate in stronger markets, and you're actually participating in a weaker market. So now, let me take this and let me connect them up. So let's say we have some kind of breakout going on here. Let me pull this back a bit. So we have a breakout from the trading range, and it doesn't pull back. The market is so strong that it is unable to pull back, and we are doing the 236 levels here. And then after the market has been this strong, it starts to be a little bit weaker. So it goes from a tight bull channel to a broad bull channel, like that. And then it becomes even weaker, and it goes into a trading range. So this looks like something that you have seen in the market, I assume. So what people do when they trade fibs, for example, they go here and they say, oh great, 618 retracement. I'm going to buy if it goes to 618 again. Because what we always do in trading is that if the market has been doing something, we expect it to continue doing that same thing for some time. So the next time it doesn't go to the 618, maybe it goes to the 236. And you think, oh, damn it, I missed the mark, I missed this trade. Let's just buy breakouts instead. So let's buy a breakout here. And then it goes actually only a small piece, and then you're getting stopped out, and it goes down maybe wicks below this point. And what you fail to see is that we've actually gone from a trading range to a strong market, to a broad bull channel, and to a trading range. And the market keeps changing its strength all the time. So if you don't pay attention to that, and if you don't learn to see when the strength changes, and you try to apply a fib or an indicator or something, you will continuously be stopped out. So here we go. We bought this breakout maybe instead because the market was so strong, right? The last move was so strong, and we were actually starting to go into a trading range. And even if you learn to spot these changes in the market, you will run into these problems when the market changes its stride. So we call this the market stride. So here the market has a stride. It has this sort of angle. You can see the angle of the trend line. I've actually messed this one up. Let me copy it back. So we have a stride here, and this stride is stronger than this stride, and so forth. You can see it on the angles of the trend lines. And also this market change will keep messing up your trend lines, so you need to pay attention to that as well. So you will need to redraw trend lines all the time because the market is changing its strength all the time. But this is why your fibs don't actually have very little predictive power, because they only have that predictive power for maybe a move or two, and then it will change. So what people also do with indicators is that they measure this stock here for, I don't know, maybe 10 years back, and they backtest it for 10 years, and then they change the settings of their stochastics or their RSI or something like that, and they say that, well, I've backtested and tested it with these settings for the last 20 years, and now I have the best settings for this instrument. Well, you'll get sort of like an average of all of these different strengths, and then you just blatantly jump in when your indicator says, without paying attention to where you are in the market cycle and what strength the market currently has. What you must understand is that the market is always changing its behavior, and you must adapt to that behavior change and see that change all the time. And your indicator is unable to do that. You will have to actually, unfortunately, you will have to develop skill to see what the market is doing. And you can learn to see the stride changes. So for example, in Wyckoff methodology, we have something called change of behavior and change of character. So for example, we have this great move up, and then we suddenly have a much stronger move down than we've had before. So that's actually a change of behavior. And when we are unable to create a new high, we say that the market confirmed that strong down move. So this down move is the strongest we've had since back here. So we have this uptrend, which was great if you were in it early. And then we suddenly have a big move down. This move is stronger than this move, and so forth. So that's the change of behavior. And then we're looking for a confirmation that this weakness will remain for some time. So this an inability to move higher would be the change of character. So now the market has changed character. So we saw a different move than we've seen before, and then we see a confirmation of that. And now we suspect that we are either in a trading range again, and or we are actually in a reversal of some kind. So you need to start paying attention to what the market is doing. You just can't follow the trend anymore, because the trend might be dead. So, or at least temporarily. So what you can also do in these different market conditions, you have to adapt your trading behavior. So if you're in a market condition that looks like this stuff here, very strong bull channel, you can buy breakouts in this market. So you can just buy here, and it won't retrace. If you're in a market that's in a trading range, trading breakouts is going to just wreak havoc on your account. If you try to trade this breakout, it's going to be really bad for you. Now, you can trade breakouts in this broad bull channel, but it's not going to be super profitable. You'll get in very late, and you just have to wait several swings. So if you're trading this type of market, you're going to have to employ a different approach. So what do you do here? Well, you draw the channel line, the demand line, and then you start putting in limit orders at these points, and you use a wide enough stop that you don't get stopped out if it changes its behavior and start to go lower. And if it does that, you just wait and you try to get out at break even at some point, or maybe with some small profit higher up. Same thing with trading ranges. You don't buy breakouts, you use limit orders to buy at the bottom of the breakout. But here you can trade breakouts, fine, but you have to identify what kind of condition the market is in. So I hope that helps. It took me a long time to understand the relation between the market stride, the market strength, to fibs, indicators, and my trading in general. So, but you also have to pay attention to the cycle that you're in. So we have an accumulation, and then we have a trending move called markup, and then we go into another reaccumulation or possibly distribution. So you have to sort of figure out where you are in the life cycle of the market as well. And that could really help with figuring out whether this is something really bad happening or this is just a pause in the market. And it also helps you figuring out what strategy you should employ. Should you be buying breakouts? Is that fine? Or should you be using limit orders? Should you be using stop orders? And so on and so forth. So I hope that was helpful. And till next time, take care.